Well, we're out of the garden today and we're in Sydney. I can assure you that I will certainly be back in the garden from time to time, so we won't miss the greenery altogether, but it is nice to have the background of Sydney, and it's nice to be in Sydney for a few days. And of course, what else was nice was the 3.3% increase in GDP in the September quarter for Australia. That followed that 7% contraction in the June quarter and the 0.3% contraction in the March quarter. That, of course, those two consecutive negative quarters defined a recession, but Australia, of course, has bounced out very sharply out of that recession. And it was a stronger number than the market was expecting. The market was around 2.5%. We're at 3%, so we're much closer to the actual. We do have an advantage in our forecasting of the GDP because at the moment the big unknown is what's going on with consumer spending. So in the June quarter it contracted by 12.5%, and in this quarter it expanded by 7.9%, and that was a bigger number than the market was expecting. Now we have an advantage there in the sense that we have the Westpac card tracker, which measures the transaction turnover in our credit and debit card activities, and those numbers have been very strong in the last couple of months as the Australian economy has been reopening. And let me say that they continue to be strong, particularly with the reopening of Victoria, and we've got that data up to date within the last week. So going through the months of October and November, those numbers are strong, and that's pointing to, I would imagine, quite a strong quarter for the December quarter as well. Now within that spending, we found that goods consumption was up 5.2%, but services consumption was up by more than 9%. Incomes were important, so wages were up by 2.3%, and non-labour income, which is very much driven by government payments, was up by 2.4%, and overall household income was up by 3.4%. So we had 3.4% jump in household income, and the savings rate came down from 22.9% to 18.9%. So the lift in incomes plus the fall in the savings rate accommodated that 7.9% jump in consumption. But the good news is that that savings rate of 18.9% means that the household sector still has plenty of firepower to continue to boost their spending. And of course, the Westpac Consumer Sentiment Index that printed for November was at a 7-year high, indicating that that momentum is likely to continue through the December quarter. Another indication that the December quarter is going to be strong on the consumption front is that outside Victoria, consumption in the September quarter was up by 11%. Victoria was down by 1.2%. And with Victoria being 25% of the economy, we can certainly expect to see a big turnaround in Victorian spending in that December quarter. Other components of spending were not so significant. So we had a 4.1% fall in business investment, and that was the same as we saw in the June quarter. And that is interesting because businesses have also been benefiting from the government payments. We estimate that in the September quarter, government payments were up over 90 billion, and we're expecting them to fall to 30 billion in the December quarter, 20 billion in the March quarter, and only 2 billion in the June quarter. So the consumer and business are going to have to cope with substantial reduction in the amount of support coming from the government. So from the consumer's perspective, that very high savings rate is going to be very important to maintain that consumer spending. We also saw a modest contraction in dwelling construction, but that included a big 5% jump in renovations and additions. So what we're seeing is that the people who have been stuck at home have decided to boost the quality of their houses by lifting their renovations. That's likely to be an ongoing issue for the Australian economy. From the perspective of the authorities, it's important to note that the Reserve Bank was expecting that growth in the second half of the year was going to be about 3.5%. and yet it's come in at 3.3% for the September quarter, and clearly the December quarter is going to be another strong quarter given what we've seen with regard to the momentum of the consumer and that high savings rate. So the Reserve Bank is going to be having to significantly revise up its forecast for growth in 2020. And that'll also mean that that 8% unemployment rate that they're forecasting by the end of the year is likely to see a substantial downward revision. For next year, they're forecasting growth of around 5%, which looks pretty solid. But if the starting point for unemployment is in the low sevens, which is where we expect it to be, then the unemployment rate by the end of next year is likely to be lower than the 6.5% that the Reserve Bank is currently forecasting, and certainly lower than the 6% they're forecasting at the end of 2022. Now, the important point to note there is how markets are going to respond to this. Because if markets start to see a much lower trajectory for the unemployment rate, they might start to question whether the Reserve Bank will remain on hold for 3 years on that cash rate. So if we project out into next year and say into the late next year, and the Reserve Bank still holding that 3-year cash rate, 3-year bond rate at 10 basis points, markets might start to get a bit restive. Our view is that that 10 basis point target will be held until around the first half of 2022, but I expect to see quite a lot of activity in that direction in 2021. In fact, whilst people are saying, well, the cash rate isn't going to be moving, that's true, but speculation around Reserve Bank policy, around bond rates, and quantitative easing as well, I think will be very, very lively in 2021. Last week, the Reserve Bank Deputy Governor indicated that long-term interest rates are less important to the economy than short-term rates. The quantitative easing policy, which is to purchase $100 billion by June next year, is very much related to holding down long-term rates. So it seems likely that they will be adjusting the quantitative easing policy before they adjust the yield curve control target of 10 basis points for the 3-year bond rate. But all of those issues are going to be heavily influenced by the outlook for the unemployment rate next year. And of course, that's going to be directly influenced by the momentum in the economy. And today's number, of course, has given us confidence that that momentum is going to have to be revised up. The other important point is the role of the state governments at the moment. So we talk a lot about the Reserve Banks, about the Commonwealth Government's deficit of $213.7 billion for 2020, 2021. But now that we've seen all the state government budgets, we know that the combined deficits of those state governments is now $99.9 billion in 2020, 2021. So the state governments are playing a significant role as well, and the boost that they're providing is also going to be very significant for the momentum in the economy. And of course, the third leg is that we have talked about the current contraction in the contribution that the Commonwealth authorities are going to be giving to the economy. But bear in mind that there's a budget in May 2021, and there's an election likely in May 2022. So if the economy does lose momentum, and today's number suggests that that's unlikely, but if it was to lose momentum, then we can expect to see the Commonwealth authorities providing more stimulus through the Commonwealth budget. The one issue that we remain troubled by for next year is going to be a number of one-off headwinds. Firstly, the insolvency laws that have been deregulated coming back into line at the end of this year. Secondly, the loan deferrals that the banks have already successfully got down by about 70%. But the worry is that there's a rump there. And indeed, even if we look at commercial property, those yields have remained very steady, but that market hasn't really been tested yet. Of course, the other big positive is around house prices. And we have recently revised our forecast for house prices next year to a plus 4% and a plus 10% in 2022. Momentum there, of course, is strong, and we've seen the big boost to confidence in the housing market from the Westpac Consumer Sentiment Survey, from the huge surge in new lending going into housing at the moment, and all of the partial indicators, apart from rents and vacancies, pointing in that direction. So that's going to be another boost for the economy over the next couple of years. So in summary, today's number was very strong, and for me the most important aspect of today's number was that very, very high savings rate that's still there, that's providing the household sector with plenty of capacity to continue to spend, even when we start to see a withdrawal of the government support. Thank you.